stock of the day, though, thought we'd have a look at Westpac after this morning. It announced it will lose $173 million in the 2023 financial year due to certain one-off items, including the sale of its asset management business and write-down of assets. The bank sees an increase in provisions for customer refunds and restructuring costs, among others, in fiscal 2023. Westpac reported net profit attributable of $5.69 billion in fiscal 2022. The company said net impact of these one-off items will reduce the bank's common equity tier 1 capital ratio by 4 basis points. Mark, Westpac's announcement, any surprise that...
Well, Westpac's hasn't been a good performer anyway. So before the announcement, I didn't like it.
Right.
So we've actually been out of all the banks apart from Macquarie. In some cases, some of our members still have Macquarie, which has been the standout performer, even though you could argue they're not really a bank like the traditional big four banks are. Of the big four banks, CBA has by far been the best, and Westpac is down in the bottom half of that equation. We're showing they're returning a negative 2% a year at the current share price. So even though the PE ratio is 12.2, which is down the bottom of the green for its range, it's still too high, based on its earnings profile. And if you look at their return on equity, it's been declining over the last 10 years, and it's actually come down from 16 down currently 8.5. So it's nearly 50% reduction over time.
So this isn't a new thing. Sort of banks are under a bit of pressure, and everyone's got concerns. Will their bad debts rise? Impact on housing market of rising interest rates, and all in the now, in the cycle.
Yes.
But this has been going 10 years from your point of view.
It has.
So it's...
Well, the other thing is the banks have actually
Not a
had,
shock.
because they were still paying what were perceived to be good dividends, which now aren't, with inflation and interest. The cash rate's at 5, you can get 5.6 apparently now on call, from one of the banks. Because that's the new risk-free rate, then your dividends have got to be above that, otherwise why would you do it? So the banks, I think, are all generally overvalued. So even though Westpac's at the bottom of its green at 12, it's still too high.
Right.
I think it should be sub 10. Now, whether it'll go sub 10, who knows? But at the moment, from my point of view, when all I could expect is a negative return, why would you want to own it? And plus, they've got a lot of headwinds going forward, as you said, with potential insolvencies. There's a whole range of stuff that hasn't hit yet.
No. I suppose, because NAB has a bit more business lending, a bit more of a business bank, but all the big banks like Commonwealth Bank, Westpac, ANZ are basically massive
building societies,
aren't they? So I suppose the only thing that's helping them is that property prices are still going up. But you might not be able to afford your mortgage repayments, but you're not in negative equity.
No, that's true. But I think it's like we're investing to make a return on our capital. So we're foregoing spending our money
and a
now.
real return.
We want to get a real return.
Yeah.
So if I can't get a real return on something like a bank, Westpac's not going to go broke. It's not going anywhere. So you're not going to lose your money, but you're slowly deteriorating over time if it's not keeping up with inflation.
Grady, what's the Bell view?
Yeah, Bell don't have a view on the big banks, but I had a look at it and I think...
Bell don't have a view on the big banks?
No, they don't.
What,
Bells don't cover the big banks. No, our financial analyst, I think they left a little while ago, so I think they're looking to replace that analyst.
Right.
But no, at the moment we don't have any ratings on the big banks. But CBA is, as Mark correctly said, it's the one that if you're going to be in a big bank, CBA has a proven track record. It's a strong bank. It's a strong performer. It's a leading bank. Right. Westpac, not so much. I'm actually just awaiting the full results out on the 6th of November, because then you can kind of dissect exactly what's going on. So you can see provisions for doubtful debts. You can see net interest margin.
Sort of preemptive announcement to say full market disclosure.
Yeah.
This is what we're going
to do. The significant items was today.
Yep.
And then the 6th is obviously the whole result. So I'm actually really excited to see what comes out, because I've been keeping an eye on the banks and seeing what the net interest margin is doing against provisions. And it's really interesting because over the last few reports and updates, they seem to have changed the name of provisions each time, some of them. So I'm like, I don't know if they're trying to hide it or I don't know, but it's
But
like...
the marketing team's got involved
I have
now.
no idea, but it's really interesting because it's normally provision for doubtful debts, and then sometimes it's just provision, sometimes it's provision, and so just looking at it, it's like, oh, so no, it's that's the one that will catch my attention. At the moment, it's like today's obviously $173 million hit to the profit. It's not as bad as last year. Last year was $874 million hit to the profit. But again, big banks aren't where I play, so I'm avoid at the moment. But
all right,
yeah.